Over the last few days, a lot of people have seen headlines about the Iraqi dinar and immediately jumped to conclusions. Some assumed it meant an instant revaluation. Others dismissed it entirely as just another technical update that doesn't matter. Both reactions miss what's actually happening, because this isn't the kind of news that makes sense at first glance. It doesn't come with dramatic announcements or bold promises. It comes quietly through policy language, and it's easy to misunderstand if you're not looking at the bigger picture. What's being discussed here is not a prediction about exchange rates. It's not a promise of overnight gains. It's a structural move inside Iraq's monetary system. And moves like this don't aim to excite markets. They aim to change how the system functions. If you're watching the Iraqi dinar seriously, the question isn't, is this big news? The real question is, why would the central bank do this now? Because timing tells you more than headlines ever will. Let's start with what was actually confirmed, not what people assume it means. The Central Bank of Iraq acknowledged that it has reduced the amount of Iraqi dinars in circulation. That statement matters because central banks do not casually comment on money supply changes. When they do, it's intentional. This was not framed as a temporary adjustment. It wasn't described as a one-off operation. It was presented as part of ongoing monetary management. In simple terms, fewer physical dinars are now circulating inside the economy than before. That doesn't happen by accident. Currency doesn't disappear unless the central bank actively removes it through banking channels, settlements, or policy-driven withdrawal mechanisms. So this isn't speculation. It isn't interpretation layered on rumor. It's a confirmed policy action. And the fact that it happened quietly without hype is exactly how central banks prefer to operate when they're focused on stability rather than signaling. To understand why this matters, you need to understand what reducing currency in circulation actually does. When a central bank pulls money out of the system, it's tightening liquidity. This is known as monetary contraction, the opposite of printing money. It's not done during chaos. It's not done when an economy is fragile and desperate for cash. It's done when policymakers believe the system can function with less currency floating around.
Why?
Because too much cash creates pressure. When excess money circulates, prices rise faster, confidence weakens, and the value of the currency erodes over time. That's not unique to Iraq. It's basic monetary economics. For years, Iraq operated with a large volume of physical cash because it had to. The economy was rebuilding. Institutions were weak. Cash was the fastest way to keep things moving. But that phase comes with long-term costs. Reducing currency in circulation signals a shift away from emergency-era policy toward discipline-based management. It says, we are no longer flooding the system to keep it alive. We are regulating it to keep it stable. This doesn't guarantee appreciation. It doesn't promise a new exchange rate. What it does tell us is that the central bank is focused on control, not expansion. And that distinction is critical, because no currency strengthens until control comes first. To understand why this move matters, you have to understand where Iraq is coming from. For much of the past 2 decades, Iraq's economy operated in survival mode. After years of sanctions, conflict, and institutional collapse, the priority wasn't efficiency, it was functionality. Cash became the backbone of the system. Government salaries were paid in physical notes. Daily transactions relied heavily on cash. Banking infrastructure was limited, and trust in institutions was fragile. In that environment, having large volumes of currency in circulation wasn't a policy mistake, it was a necessity. High denomination notes existed because the currency had lost purchasing power over time, and people needed larger bills just to handle routine transactions. That's a common pattern in post-conflict economies. But what works during recovery becomes a liability during normalization. As the economy stabilizes, excess cash creates distortion. It fuels inflation. It complicates monetary control. And it makes it harder to modernize the financial system. So the large volume of dinars in circulation wasn't the result of carelessness. It was the result of history. What matters now is that Iraq is no longer operating under the same conditions that required those policies in the first place. Central banks rarely explain their strategy outright. They communicate through actions. Reducing the amount of currency in circulation is one of the clearest signals a central bank can send, not to the public, but to institutions, investors, and international partners. It tells us that the Central Bank of Iraq is prioritizing control over convenience. This kind of move suggests several things at once. First, confidence. A central bank doesn't tighten liquidity unless it believes the economy can absorb it. Second, discipline. It signals a shift away from short-term fixes toward long-term management. And third, preparation. You don't clean up the money supply unless you're aligning the system for future steps, whether that's financial modernization, currency restructuring, or deeper integration with global markets. This doesn't mean something dramatic is about to happen tomorrow, but it does mean the foundation is being adjusted deliberately. In monetary policy, groundwork always comes before visible change. And this is groundwork. Now, this is the part that matters most for anyone following the dinar. This move does not mean there is an overnight revaluation coming. It does not mean exchange rates are about to jump suddenly. And it does not mean instant profits. Currency reform is a process, not an event. Reducing currency in circulation is about stability, not spectacle. It's about removing excess, not creating shock. Historically, when countries rush currency changes without proper groundwork, the result is volatility, not strength. What we're seeing here is the opposite approach. Careful, incremental, technical. That's how central banks behave when they are trying to avoid disruption, not create it. For observers and holders, the takeaway shouldn't be excitement. It should be understanding. This move doesn't change the value of the dinar today. What it changes is the structure behind the currency. And structure always matters more than headlines. This move by the Central Bank of Iraq doesn't stand on its own. It fits into a broader pattern that's been developing quietly over the last few years. Iraq has been working to modernize how money moves through its economy. Less reliance on physical cash. More use of formal banking channels. Greater transparency and compliance. Reducing the amount of currency in circulation supports all of those goals. A cash-heavy system is difficult to monitor, easy to exploit, and hard to integrate with international finance. Tightening the money supply makes reforms elsewhere possible in banking, payments, and oversight. This is how reform actually happens in practice. Not with one dramatic announcement, but with a series of technical steps that reinforce each other. Seen in that context, this decision isn't about making headlines. It's about aligning Iraq's monetary system with where the country wants to go, not where it's been. This is where confusion tends to spike, so clarity matters. A revaluation is a change in the exchange rate, how much the dinar is worth against other currencies. A redenomination is a change in how the currency is structured, typically reducing zeros on banknotes to simplify transactions. They are not the same thing. Redenomination is often used when an economy has moved past a period of inflation and wants a cleaner, more practical currency system. Prices, salaries, and contracts adjust proportionally. Purchasing power stays the same. Revaluation, on the other hand, directly affects international value. What many people miss is that redenomination is about usability and confidence, not instant gains. It can support long-term credibility, but it doesn't create wealth by itself. Understanding this difference prevents unrealistic expectations and helps people interpret policy actions accurately instead of emotionally. Instead of watching rumors, serious observers watch indicators. First, look for continued changes in liquidity management from the central bank. Consistency matters more than one announcement. Second, watch banking sector reforms, especially efforts to reduce cash usage and expand electronic payments. Third, monitor inflation trends. Stable or declining inflation confirms that monetary tightening is working. Fourth, keep an eye on fiscal coordination. Monetary discipline only holds if government spending stays aligned. None of these indicators are dramatic on their own, but together, they tell you whether reform is real or cosmetic. This moment matters not because it promises something immediate, but because it confirms direction. Reducing currency in circulation is not a shortcut. It's not a guarantee. It's groundwork. And groundwork is what separates long-term progress from short-term noise. The Iraqi dinar's future won't be shaped by speculation. It will be shaped by discipline, coordination, and consistency. If you're following this story, the most valuable position you can take right now isn't excitement, it's understanding. Because when currencies change meaningfully, the signs always appear quietly first. If you value clear analysis over hype, stay subscribed, and we'll continue tracking what actually matters as this process unfolds.